How many people here keep extra cash in their portfolio in case of redemptions? No one will raise their hand because no one likes to admit it. But every single bond investor in the room does it, right? And those who don't, or don't do it too much, they'll keep a slightly more liquid portion of bonds in the bond portion of the portfolio, right? So the portfolio will be 3% cash, 7% liquid bonds, 90% the bonds they really want to hold. And that 10% of cash plus liquid bonds are probably generating 0.5%, 1% of cash drag. So the number one use we have, our bond clients tell us that they use our ETFs for, is to get quick exposure, or to maintain exposure instead of cash, clip away the yield, because they know that if they need to get a redemption, they can sell the ETF on exchange much cheaper. Some clients will hold the ETF until they find the bond they want, because it's not always available when the subscription occurs. So if there's an inflow into their portfolio, they have a choice. They can either buy whatever bond that comes across their desk that day to avoid cash drag. They can sit in cash, wait until they find the right bond. Or they can buy one of our ETFs at 1 basis point bid-ask, get the beta exposure, get the spread tightening, spread compression if it occurs, the yield, keep looking for the right bond. And once they find the right bond, they sell the ETF, buy the bond. Very efficient. For the bigger investor in the room, we didn't design the ETFs to do this, but clients have figured it out and have started doing it. ETFs are structured to allow in-kind transfer of the bonds inside them, in and out. So we've had clients who wanted to build a nearly $1 billion high-yield portfolio and knew that it would take them 3-4 months, and every single dealer in the street would know that they're in the market for high-yield bonds. So people would front-run them. So what they did instead was, over about a month or two, they bought our ETF in very small clips. And remember, you can buy an ETF on exchange through a VWAP trade, for those familiar with equities, anonymously. No one knows that you're trading. They bought about $800 million of our ETF over, I think it was 4 or 5 weeks. And then they redeemed, but instead of redeeming for cash, they took out the bonds. So they got a pro rata portion of our high-yield ETF, which held 1,200 bonds at the time. They didn't get all 1,200 bonds. They got about 200. But those 200 bonds were the same duration, the same sector risk, the same spread duration, the same credit quality breakdown, same curve exposure as the index they were looking to replicate. And then they adjusted some weights for their active portfolio. Nobody knew they did it, and it happened in 4 weeks instead of 5 months. And it happened at, obviously trading that size, it's not going to be exactly 1 basis point. It happened a little bit wider, but it never crossed 5-6 basis points. And this was all in price terms, by the way, not yield terms. You could also go the other way. There was a large pension fund in the US. There was actually an article about it. They did it 3 years ago, and there was an article 3 months ago. So this is the point of anonymity. The CIO finally talked about it. They had a $2 billion portfolio of 1,600 bonds, where they were employing people to reinvest coupons, monitor credit risk, write reports on the illiquidity of bonds they purchased in 1997 that they're still holding because they have 10 years to maturity. And what they did is they worked with us to identify which ETFs look a lot like that portfolio. And it ended up being 2 of our ETFs. They transferred the entire portfolio into our ETFs. They went from 1,600 line items to 2 line items. And then they sold half of it, and they kept the remaining half, again, in 2 line items. Talk about a simplified balance sheet, 1,600 to 2 to 2. So those are some of the uses. And of course, there's also things like being able to trade tactically in markets where you don't have a core expertise. So a lot of my clients in Taiwan, they like to have hard currency emerging market debt exposure. But they're in no way staffed to invest in individual bonds. So they buy an ETF when they need the yield. They sit on it. When they think the risk is too much, they take the ETF off. Much easier than actually setting up accounts to trade the bonds, dealing with withholding tax arrangements. All of that happens inside our ETF. So they just do one equity-like trade.